Hi, welcome to PM Tycoon. In this video, we will learn Sharpe Ratio and how to build an optimized portfolio using Sharpe Ratio. Let's get started with it. What you see on the screen is an Excel which at a click of a button tells you which stocks you should invest in and which stocks you should not invest in, and also how much allocation you should do for the stocks that you're investing in. See here, we have 5 stocks, S&P 500 to Amazon. These are very good, fundamentally strong stocks. If I ask any normal investor that I'm going to give him $100 and I want him to help me allocate my $100 among these stocks so that I can get a maximum return with low risk, what do you think? Would he be able to help me with it? What if I ask you the same question? Can you help me choose allocate $100 among these stocks? I know most likely you may not be able to do the right allocation, but you may spread it in equal proportions like you see it on the screen here. 20% each to all these stocks, because we have 5 stocks, 20% into 5 is going to be 100%. So you may invest $20 against each of these stocks. The question is that the right allocation? Let's see. Let me ask my personal hedge fund manager. Let's see what he is going to suggest. This button that you see here, he is my hedge fund manager. Let me click it and see what my hedge fund manager has to say. What my hedge fund manager says is I should invest 15% in Apple and 85% in Microsoft to get maximum returns with a low risk. And this is actually the difference between a normal investor and a professional investor. If you want to upgrade yourself from a novice level investor like you see on the left of the screen to a professional level investor like you see on the right in just one video, then all you have to do is stick till the end of this video and pay attention to the discussion points, and I will help you to get there. The motto of this channel is to make concepts clear, no matter how complicated they are. And it means that I have to do a lot of heavy lifting for my subscribers. And I'm happy to do it. And if you still haven't subscribed, please do subscribe. Let's start with a simple question like the one you see here and build our understanding to reach to a point of the Excel you have just seen. I have to pick between option 1 and option 2. Option 1 will give me $160 in a year, and option 2 will give me $140 in a year. And what should I choose? This is a very elementary level question, and I get it. And there is a reason why I'm taking you from a very basic question of plus and minus. Okay. So on the screen you see, right? So anyone can say it's option 1 because I'm getting $60 here and I'm getting $40 here, right? Which is option 1 is 60% return. Option 2 is 40% return. I hope you know how to calculate the percentage, right? If not, this is how you do it. 160 minus your investment divided by your investment. That gives you 60%. Likewise for option 2, we get 40%. It's very simple. So let me add one more parameter here, which is risk. I have the same question as we have before. I need to choose between option 1 and option 2. However, there is a 50% chance of risk. And in option 2, I'm getting $140, but the chance of risk is little less, which is 30%. What should I choose? For people who have high risk tolerance, they may still say, I want to go with $160. And people who do not have high risk tolerance, they want to reduce the risk, they may go with $140. But that's not the point of this video. The point of this video is what is the right option, right choice. That's what we're going to learn in this video. In addition to this, I'm going to add complexities one after the other, and I'm going to make it easier. I'm not explaining the answer right away. I'll explain that in a moment. But I want to show you one more question, which is a level 3 question. In level 3, what we're doing here is instead of picking between one stock and other stock, we're saying we have to choose between portfolio A and portfolio B. Portfolio is nothing but a collection of stocks combined together. Okay. Portfolio A has 5 stocks. What it means is we are having 5 different stocks grouped together, and that group is being called as a portfolio. Portfolio B has 7 stocks. So we have 7 stocks in a group and we're calling it as portfolio B. What we are saying here is portfolio A is giving a combined return of 18%. Combined return of 5 stocks is 18%, but it has a risk of 12%. And again, in portfolio B, which has 7 stocks, we have a combined return of 14% with a little low risk of 9.5%. And you also see something here like bank interest I'm adding here. I'll get to a moment why I'm adding this bank interest rate here. But the idea is to get your understanding clear between selection of stocks and selection of portfolios. We will answer level 2 and level 3 in just a moment. Okay. So let me switch to level 2. In level 2, we're saying we're having a 50% risk on option 1 and 30% risk for option 2. We know the profit of option 1, it is 60%. And we have a risk of 50%. And for option 2, 40% profit and 30% risk. If I give you the straightforward answer how to calculate what is the best option to choose here, it's simple. Divide your profits by risk. If I go for option 1, it's 60% by 50%, which is 1.2. And for option 2, it is 40% by 30%. It is 1.33. The higher the number, the better. Okay. But now that we have added risk, we are choosing option 2 because by adding risk, the dynamics have changed. Okay. So this is simple. Sharpe ratio is nothing but your returns by risk. But what I have shown you so far is half truth. Okay. In fact, we should not directly divide your profits by your risk. The reason is, let's consider this. If I'm not investing my $100 into the stock, I may be investing this $100 somewhere else where I'm told that I'll be getting guaranteed returns. So let me take bank interest as an example. If I go and put my $100 in a bank may give me at least 4% per annum. This is like guaranteed money, correct? Now, if I'm not investing in stock, I'm getting 4%, right? Be it option A or be it option B, the bank rate is going to remain the same. So if I'm not investing in any of the stocks, I am supposed to get 4%. So in reality, your profit is not 60% for choosing option 1 or 40% for choosing option 2. In reality, your profit is 60% minus 4% because this is something that we were supposed to get for sure. We're losing this. We have to remove this amount. So for option 1, the actual profit is going to be 56%. And for option 2, the actual profit is going to be 40 minus 4, 36%. Okay. So what we need to do is, instead of dividing it by 60% by 50%, we have to do it by 56% by 50% for option 1. And we have to do it 36% by 30% for option 2. So if I do the math, 56 by 50, it's 1.12. And this is 1.2. Option B is giving us high returns. So we should pick option 2 here. Sharpe ratio, right? People explain Sharpe ratio is your excess return by risk. Sharpe ratio is excess return by risk. When we say excess return, we're talking about removing your guaranteed returns from your profit. That's called excess return. The higher the Sharpe ratio, the better the investment. So in this case, just by adding risk as one more parameter, the dynamics of our investment have changed. Before it was option 1 and now it is option 2. What you see on the screen is a Sharpe ratio formula. Sharpe ratio formula is written as excess return divided by standard deviation. Let's talk about excess return first. As we just explained, excess return is nothing but your actual returns minus guaranteed returns. Guaranteed returns is also called as a risk-free return. Why is it a risk-free return? Because it is guaranteed to be received. Since there is no risk at all, we call it as a risk-free return. Now, what are the other types of risk-free returns? One is your bank interest rate. If you trust the bank, then you can consider it as a risk-free return, whatever the interest rate they offer you. Or you can also consider government's treasury bonds as a risk-free return. So most of the investors consider government treasury bonds for their risk-free returns, but you can also consider other investments or other returns where you think you are guaranteed to be received. Okay, so excess return can be written as actual returns minus risk-free return. Okay, now we see something called standard deviation. We haven't spoken about it. In the previous example, I said it is excess return by risk. Now, why are we calling it as standard deviation? Standard deviation is nothing but the volatility of the stock. You might have heard from different investors saying that, what does it mean? It means stock is highly risky. It can go up and it can go down in a very short span of time, which means you have risk on the both sides. You can either earn money because of the stock volatility, or you can also lose money because of the stock volatility. The lesser the volatility, the lesser the risk. The higher the volatility, the higher the risk. So volatility is computed using the standard deviation for a particular stock. Okay, in mathematical language, it is called standard deviation. However, in our financial language, we call it volatility, but they both represent the risk of the stock. So you can write Sharpe ratio as excess return by risk or excess return by volatility. In the previous questions, we have just spoken about stocks. In these examples, we're not talking about a particular stock. We're just talking about portfolio of stocks. Here we have two options, which is portfolio A with 5 stocks, portfolio B with 7 stocks. If you look at the question carefully, there is nothing much of a difference between the previous example and this example. Here we have everything. What we're saying is portfolio A combined together is giving 18% returns. Portfolio B with 7 stocks combined together is giving 14% return. We are saying risk is 12%. Risk is nothing but standard deviation. And here risk is 9.5%, which is again standard deviation for option 2. Bank interest rate. Now going forward, instead of calling this as bank interest rate, we can just call it as risk-free rate. Okay, so bank interest rate is 4%. Here we have risk-free rate as 4%. While it may be confusing because we are saying portfolio of 5 stocks, but what we are talking about is 18% return for the combined 5 stocks in portfolio A. So we just take this 18% as it is. The risk-free is going to be 4 divided by 12. This is going to be the Sharpe ratio for portfolio A, and portfolio B, it is going to be 14 minus 4 by 9.5. If I do the math, it is 14 by 12 for option A, which is 1.16, and this is going to be somewhere around 1.05 if I do the math correctly. So in this level 3 question, we're just going to choose option 1. We're going to go with portfolio A because portfolio A Sharpe ratio is higher than portfolio B Sharpe ratio. This was easy so far. Okay, when I started my questions of level 1, 2 and 3, it might have looked complicated for you to even portfolio to invest in. Okay, now that it is clear which portfolios to invest in using Sharpe ratio or which stock to invest in using Sharpe ratio, it should be easy for you to determine how to use Sharpe ratio. But again, the real question is, you should ask, how did you compute the returns? Or how did you compute the risk for a stock or for a portfolio? That's what we're going to learn next. So far until this point in video, we have learned how to compute Sharpe ratios, but we were given the returns, we were given the risk, and we were given the risk-free rates. Using those three, we are able to compute the Sharpe ratio. But in reality, in real life, if you are working for a financial firm, they would ask you to compute the returns for a particular stock. They would ask you to compute the risk for a particular stock. And they may tell you to consider government treasury bonds as a risk-free return. And they may ask you to compute Sharpe ratio for different stocks. So now I'm going to show you how to compute the returns, the standard deviation, and then derive the Sharpe ratio for a particular stock. Let's take Apple as an example and then compute it. So where do we start? We have to start by going to Google. Okay, let me just go to investing.com. Let me type in, all right, Apple we have up here, recent searches. I'll go to historical data. I will take time frame as monthly. We are going to compute yearly returns and we are going to compute yearly risk rate. So I'm going to compute yearly risk rate. So I'm going to take the date range from whatever is available. Let me go back to 2018 Jan 1st until today. So here is the data, month-wise data. What I'm going to do, I'll just copy all the rows, all the data until here. Control C. I'll open Excel. So I'm going to copy paste the data here. I'll just do copy and paste values. Okay, I see it is copied properly. Let me remove the last row here. We are going to compute yearly returns. We are going to compute yearly risk first. Okay, so if we have to compute returns, what are we talking about when we say returns? Returns is nothing but if I take monthly data, how much return did I get in this month compared to previous month? So let's compute the returns. For us to compute the returns, first we have to take this month's price and then we have to minus previous month's price and then we have to divide it by previous month. That will give us the return for this month. Because of BODMAS, we have to make sure we have to put this in brackets. So let me make it percentage. It is 5.56. See, that particular site is already giving us the returns. Okay, they're calling it as change. Okay, now let's do it. See, it's exactly the same. Okay, here we get day 0. That's because we don't have values down there. Computed here is monthly returns, correct? So let's do compute average monthly returns so far. Okay, average returns. When we say average, we just have to say equal to average and then select all the values from here till bottom, close the bracket. So 2.93% is the average monthly return for Apple. What we are saying here is every month you get minimum of 2.93% return. That's a pretty good return. Okay, I'm not asking you to go ahead and invest in Apple. I'm just saying, just by looking at this number, I could say it's a pretty good return. Okay, so this is the average return. Now what we said, we want to compute yearly returns, right? So if I'm getting 2.93% on a monthly basis, how much would I get on a yearly basis? Basic elementary question. We just multiply the average with 12. We get a yearly return of 35%. Okay, so that's the average yearly return for Apple stock. Now we have to compute the risk, right? Now for us to compute the risk, there are two things we need to do. We need to compute the standard deviation on a yearly basis. Now against which number are you going to compute the standard deviation? You're going to compute the standard deviation against these returns. Okay, so first we have to compute the variance and then we have to compute the standard deviation. Why variance? And if you have to really understand what is the difference between variance and standard deviation, you can do a Google and learn about it, because if I cover this here, the length of the video is going to be very long. But understand, variance is the square of standard deviation. Let's first compute variance, and then we will do the square root of variance to get the standard deviation. So first, let's compute the average monthly variance. Okay, so for that, what we need to do is equal to variance. This is a sample data, not the complete population, so we'll select var.s and then select the entire range and close it. What we are getting is a monthly variance. Okay, average monthly variance. Let me convert all this into percentage. So the variance is 0.83%. And if I compute this, sorry, we need to first do a yearly variance, right? Because we are doing a yearly risk. So that's the average monthly variance. So the yearly variance is going to be 0.83 into 12. If I put it in percentage wise, it's 9.98% variance. As I said, standard deviation is nothing but the square root of variance. So we've already computed the yearly variance. So let's compute standard deviation on yearly variance. So all I have to do is equal to square root, select this variance, close it. 31.58% is the standard deviation, right? So now we have gotten the yearly returns and the yearly risk. Standard deviation is nothing but the risk. So now let's compute the Sharpe ratio for Apple stock. The formula for Sharpe ratio is excess return by standard deviation, right? For us to get the excess return, we need to remove the risk-free rate. Let's consider government treasury bonds interest rate per annum as a risk-free rate. And if we take the last 10 years, it hovers risk-free rate as 3%. Now let's compute the Sharpe ratio. For us to compute the Sharpe ratio, first we need to compute the excess return. Excess return for Apple is going to be yearly return minus yearly risk-free. Okay, that's the excess return. Our standard deviation for the year is 31.58%. So our Sharpe ratio is going to be excess return divided by standard deviation. You see Sharpe ratio is 101%, but Sharpe ratios usually are represented in numerical values. Okay, so let me just remove the percentage. Let me copy the format here to here. So if you're getting a Sharpe ratio of 1.01, then it's a good stock. I hope this was helpful. Now I would suggest you go ahead and pick up another stock, something like Microsoft or Tesla. Compute the average yearly return, compute the risk, and then compute the Sharpe ratio. By doing it yourself, you will learn a lot. We're not ending here. We still need to understand how to build a portfolio, which means we need to understand how much of our investment we should allocate to each of the stocks within a portfolio. That's a very critical part. I want to show that in this video itself. However, keeping the length of the video in mind, I want to do that as a part 2. I would recommend please watch part 2 because we are not yet done. And I'll also be sharing a couple of links for you to be able to download the Excel file in part 2, and you can use it for your personal purposes. Thank you so much. See you in the part 2 of this video.